What we're doing now is it's almost become a series. Last year, we decided we would present just some early investing information on venture capital investing, just kind of level the playing field to make sure that people, we're all talking the same thing, because these are, I'm getting some feedback here. We use these words all the time, and we want to make sure that everyone is understanding exactly what we're saying. So it was very well received, and we appreciate that, and the investors were asking for more. So I decided to kind of up it a little bit, and so this is Venture Capital 201. So we're sophomores now. We're back in school. It was 101 last year, 201 this year. So as always with any good college or presentation or school, you spend the first third of class reviewing what you did last year, and then the next 2/3 of the class with the new material. So we're just going to start back, and in this situation, it's in the beginning. The entrepreneur has an idea. They're going to start a business. What do I got to do? Well, you got to record it in your journal. You got to submit for your patent. You start your LLC, and boom, just like that, you're a founder, and you're excited. But very quickly, the reality hits the founder that says, "Oh my gosh, I got to raise some capital. I got to get some money." And the way this is almost always started is the friends and family round, and usually it's a small capital raise, 100, 200,000 or something like that. And the finance method is oftentimes what's called a convertible note, and it has evolved because family members or friends will say, "How much of your company do I own?" And the founder, they don't know how much they want to give up, and people will say, "How much is your company worth?" And this is just getting started, so that they don't really know how to put a price on it. So they do what's called a safe note or a convertible note. A safe note is just a simple, effective, a simple agreement to future equity. And what that does is allows you to kind of kick the can down the road on valuation. So a convertible note in this situation would say, "I don't know how much it's worth. You don't know how much it's worth, but I'll tell you what, when we do a priced round down the road, you'll be able to buy in at 20% cheaper than everyone else. So at that point, you've made 20% on your money. And if it happens to go really crazy, I'm going to actually put a cap on it. So it would never be more, in this example, 2 million. So if the company goes wild and it's worth 10 million, everyone's buying in at 10 million, but you'd buy in at 2 million. So they frequently have both of those, the 20% reduction, sometimes it's 15, but 20% reduction, and then there's a cap put on it to border you both ways from the extremes. And the governance, well, it's just you're the founder. And so this is how it starts off early on in the friends and family round. The next round, you've made some advancements. Maybe you've got your market research report. Maybe you got your patent issued. And this is really what we call a pre-seed round. And a pre-seed round, the capital's up a bit more. In this example, maybe 250, 750, almost always below $1 million. And the people who are investing now, you might have some diehard friends and family who want to re-up it, but to be honest, they've invested the first time in just you. They weren't investing necessarily in what you were doing. And this may get to the point where they say, "Hey, we just want to watch this." So you reach out to angel investors or some friends who still want to re-up their investment in you because they believe in what you're doing. The finance method really hasn't changed much because it's still too early to put a valuation on it. So you do another convertible note or a safe note. There's a little twist in this one. Usually at this point is interest is added. So it still would be a 20% discount, but now there's an interest element of it. So the person who would be giving you the money would be investing, that money would then sit there for 6, 8, 10% growing until the next priced round. And then at the priced round, it is now grown at 6, 8, 10%, whatever you agreed upon, and then it would convert at, again, a 20% discount and a different valuation cap because you're further on down the road. So the interest aspect of this is just the next layer of convertible note. It's really very simple to calculate, but it's a way to get these new angel investors in because the angel investors say, the price round might be in 2 years. I'd like my money not to sit for 2 years. I'd like to be growing at 6, 8, or 10%, and then convert at a 20% reduction. So that's a little bit of a change. The governance at this point frequently is a 3-seat board. Usually it's still the founder, maybe one of your family and friends who's invested again, and then maybe an angel investor. So that's kind of the governance on it. And this, again, is the pre-seed round. After the pre-seed round, things start to change. So the seed round is normally at this point when you've got a prototype, you're going to trade shows, you're showing it off, you're going to pitch sessions, and you're pitching in front of groups. And at that point, the group is getting together and looking at you and deciding, do they want to actually invest in the product? They're still investing in you, but they're investing now in the product. And now's when the finance situation changes, because now you're going to actually have a term sheet. And a term sheet is really an external validation of your company. So in this situation, an angel investor may approach you and say, hey, I'm interested in investing. Do you have a term sheet yet? And if they don't, then the angel investor will say, I'm going to do some diligence on you. I want to take a look at you. And I'm going to independently decide how much your company is worth. And that term sheet has multiple aspects, which we're going to talk about here in a minute. But it puts now an independent valuation on the company. And once there's that priced round, which is the term sheet, then all those convertible notes and all those safe notes that were just done would then convert over. So this is usually done at the seed round. Oftentimes, the valuation is $3 to $5 million at this point. You're usually raising about $1 million or so. And now the governance starts to become a little bit more formal, and you have the lead investor, maybe another venture capital investor, and you're usually still on the board. So this is the seed round, and the next round starts to get real serious, because this is called the Series A, and this is commercialization. And obviously at this point, it's still a lead investor, and the series goes on with new lead investors on each round ordinarily. So that's kind of what we covered last year in a very quick span and such. But I wanted to touch base on the convertible note, and then now the lead investor and the term sheet, because that's what we're going to talk about more. So when you compare the two, you can really just look at it and say, okay, the convertible note really doesn't put a valuation on the company. It's pretty much kicking the can down the road, and the governance for the most part at that point is the founder. Now, the term sheet puts this external validation on it. You may think the company's worth $10 million, but if everybody you talk to says the company's worth $4 million, the company's worth $4 million. That's what the market says. So that's what the term sheet does, and it actually then puts in this formal governance structure, and we're going to go into that, but it puts in a formal governance structure that is really set up to protect the company and protect the investors. And so this is now a much more structured organization, and this term sheet usually comes about in the pre-seed. So let's talk about that. I know the term sheet sounds, confusing. We've all done it. I would say every single person in this room has done a term sheet. You ever bought a car? You ever bought your house? Those are term sheets. Okay, they're simpler, but this structure is basically the same. So when you're buying your house, you and the seller, obviously through your agents, your real estate agents, are determining a price. And so you haggle back and forth on the price. You finally settle on the price, and you got that set. Then you might want to talk about occupancy. Some other things you sit and negotiate as an occupancy date. Maybe the sellers haven't closed on their next house, and they want to re-rent their house back from you as the new buyer. And so you can talk about occupancy rate, and so you can try and get a little bit more there. And then, there's all the other things. You have the inspector. We all have a home inspection before we do it. And the object of the home inspector is to find problems. And then as the buyer, you want to inflate those problems as big as possible. Well, the roof needs to be redone. That's going to be $20,000. The seller doesn't want to deal with that, so you start negotiating. How about $10,000? Okay, $10,000 is fine. So then you start going to the smaller stuff, and you start saying, well, I like the appliances. You negotiate over the appliances. And then even smaller stuff, who's going to cover some closing costs? So you kind of whittle it down, and you're just kind of swaying that price one way or the other until you guys settle in. And that's your term sheet. And that's what you do, and we've all done it. Cars easier, maybe you talk about oil changes or maybe new floor mats or something like that, but we've all done these negotiations. What's the first thing you negotiate when you're buying a house, though? First thing you negotiate? Price, right, exactly. The price of the house, the value, and then everything else is trying to sway that one way or the other. You're trying to whittle it down by all the problems that need to be done in the home, and the owner's trying to, well, I'll give you the appliances. They were going to give them to you anyways. I'll give you the appliances, but it's going to cost you a couple thousand. So that's how that goes. So think of that just as the model here, and in business here, the term sheet, it definitely has some more aspects to it, which we're going to discuss. It's definitely more complicated, but just think of the same process that goes on. So in the term sheet here, what we're going to talk about here first is on the left side, and liquidation preference. Liquidation preference, you kind of mentally think is what happens when things go bad, really bad. So liquidation preference is a situation where the company's not making it, they're closing up shop, potentially they're selling assets, and what are they going to do because they don't have enough assets to cover all the investor money. So there's the thing, at 1 to 2x, I saw 3x the other day. What this says is, if you have a 2x liquidation preference, what this says is we invest in your company. If this company goes south and you're liquidating assets, I get 2 times what I put in. And that way I've secured for my investors some return. Not only the money back, but I've invested, by have 2x liquidation preference, I've doubled your money. So as I said, I saw a 3x liquidation preference the other day. So these times are tough, and you can actually negotiate some of these things. So these are hard to negotiate, and they're difficult things, but sometimes you get them through. The next level is what's called participating and non-participating. So think about if we have a 2x liquidation preference. So the first money that comes off the liquidation of the company comes to us, and we get double our money. Then if we're participating, what that means is all the rest of the money that's available is going to get divvied up among all the investors. We want to participate in that and get our share. And you can think of it kind of as double dipping. We just got 2 times, and now whatever's left is going to get divvied up among all the other investment groups, and you want to stand in line with your hand out with them, and that's called the participating. So I saw a 3x participating the other day, and it actually got through. That's how bad the company needed money. But that's a horrible situation to be in. So the very last one over here is seniority. And this is another layer. This may say, I know you have 2 other venture capital companies here that are 2x, and I'm 2x. I want seniority. So I want to be the first of the 2x's. So you can see you can make it incredibly punitive here on these companies. And again, liquidation preference, all this stuff is when things go bad and they're having to wrap the company up. Who's going to get the money that's left over, and how is it going to be distributed? Over on this side is some other things that we'll talk about. Preferred shares. When you're investing, we always get preferred shares because they come with advanced rights. They vote as a separate group. Oftentimes they're guaranteed board seats. They have different liquidations than the common shares. So preferred shares is a class above common. So it's always when you're invested at this point, you're investing in a preferred stock, not common stock. Board of directors, that's a negotiating point. If you're investing, you would like to have a seat at the board, because if it's a 5-person board, you want to be able to not only hear everything that's going on, that's really going on. You don't want to rely on an investor's report. You want to be at the seat of the table, but you also want to be able to vote on governance and vote on the direction and help the company move forward. So board of directors, it can come in 2 fashions. It can come as an actual board seat, where you're a voting member of the board. So you're participating with 4 other individuals in this example of a 5-person board to help guide the company. There's also what's called an observation seat that you can negotiate for. And they may say, I'm sorry, I know you want a board seat, but our board is locked in. We can't offer another board seat. We're not going to go to 7. We'll give you an observation seat. And a board observation seat is still incredibly valuable because you're sitting in the room hearing all of the information. So you can report to your investors the true information. You're not relying on a sheet of information that they're putting out a press release or something like that. So an observation sheet is incredibly valuable. We've had some of us have been in an observation seat and really helped guide the company. And you realize 6 months later, the company thinks of you as a voting member because you're helping guide the company so much. So observation seats can be incredibly valuable. Protective provisions, I'm going to skip over. Sorry about that. I'm going to skip over. I've got a whole section on protective provisions. Anti-dilution, we're going to talk about. Rob spoke about that briefly. So I want to clear up 2 things on anti-dilution. If you invest in a company call it Series A, we invest and we own 10% of the company. They then raise capital a year later in a Series B. They will basically print new shares. Anti-dilution is not set up to protect you from that. That's just common dilution from new investors coming in. Anti-dilution is when you have a down round or things are not going as planned. And so in an example, if your last round was at 20 million, and due to economic times, despite the company doing very well, in economic times, they can only raise the next round. The term sheet says 15 million. That's all they can get. That's called a down round. So anti-dilution, there's a bunch of different ways that you can set up anti-dilution. And what it does is kind of softens the blow for the people who invested at 20 million a year ago, and now these new people are coming on at 15 million. There's a formula for doing this, a very commonly accepted formula. But as Rob said, there's also, you can get an anti-dilution that says, we're going to get throttled back to that same level, and it's as if we invested at 15, and everybody who's in common really takes a hit with dilution at that point. So there's a million different ways you can do anti-dilution. There's a common way to do it with a mathematical calculation that kind of softens the blow to both parties, and that's usually how it's done. But you can come up with any anti-dilution method you want to do. All right, option pool. I will tell you, this is the sleeper in here that a lot of people don't think about when they're negotiating a term sheet. So an option pool on a young company, it's good to have about anywhere from 10 to 15% of the company set aside as options. And that's stock that has not been issued, that then the company is going to issue to obtain key individuals. And not only obtain key individuals, but maintain key individuals. So if you want a new CFO, you want to have money, you want a stock set aside, so you can offer that new CFO 2% stock, 2.5% stock options. They're going to vest over 4 years. So you can get this individual you want. They're motivated to drive this company forward, and they're locked in as this slowly vests over 4 years. Then when you get around the 3-year point, you might tailor on a few more options to stretch it out to 6 or 8 years. So you want to have options in your pool to get the people you want and then maintain that good help and good employees. So if I'm looking at investing in a company and I'm looking at as part of my diligence and I see their option pool is down to 2%, well, one of my negotiating points will be, I want your option pool beefed up to 15% or 12% before I invest. Because the difference is, if it's before I invest, they just diluted themselves out 10 or 12% to get this option pool set. Then when I invest, if we're investing to own 8% of the company, we own 8% of the company. If the option pool is beefed up after we invest, suddenly our 8% investment now goes to 7.2. So you want to at least talk to them about beefing up their option pool before your money's hit. And I think this is one that is oftentimes overlooked in negotiations because it's not a high value item, but it makes a huge difference to your investors and how much you actually own if the option pool is done before you invest your money. And then obviously valuation, the price of the company. So these are the main hitters on a term sheet. We're going to go into protective provisions a little bit more, but I'm just going to ask the group here, what's the last thing that I personally negotiate when I'm in a negotiation? On this term sheet, what's the last thing I negotiate? Well, the last thing I negotiate is price, is value. Because if I can't get all those other things, the price actually doesn't matter. If I can't get the protective provisions that I need, we can't get the board seats that we need, if we can't get whatever liquidation preference, if all that structure cannot be set, the price doesn't matter. We don't want to be part of this. And so value is actually the last thing that I look at when I'm talking about it. So let's go on to protective provisions. Now I'm going to read this next slide because it's a little bit deep. So just bear with me. You don't have to try and read it there. But protective provisions are for all investors. And what it's basically saying is, we want a formal structure in this company, and without board consent, so without the board's approval, no one in the company, the CEO, CFO, no individual in the company can do the following. They cannot liquidate the company. They cannot alter the certificate of incorporation. If we invest in a company for medical device, we don't want to hear a year later that they've decided to change and they're going to build a spaceship to Mars. You can't change the direction of the company without the board. They can't create any other security or increase the number of shares of stock. They can't purchase or redeem or do a dividend on any stock. So you can envision a situation where the CFO, CEO has common stock, the board has preferred stock, and the CEO decides to suddenly issue a dividend only to common stock. Right? We don't want this happening. Okay, so you can't increase or decrease the size of the board. If the CEO's upset because they're not getting their way, they're fine. We have a 5-person board, it's going to now be a 9-person board, and I'm going to bring on 4 of my buddies. So you can't do that without board consent, all right? You can't enter into any insider transactions, pay a loan to any person, create or change control, a plan, or a retention bonus. The CEO can't give themselves a retention bonus. You can't reclassify shares of stock senior to your stock. They may say, you did a great job, Cultivate. You guys had seniority, but I just reclassified a class above you. You can't do that without board approval. So these are protective provisions for everyone, or increase the number of shares of stock. So these are the common 10. I've seen some with 12, 15, 18, very, very specific with that technology. But these are the common 10 protective provisions that come with a company. So the question is this is the guts of the term sheet. But talking about negotiating a term sheet, how I negotiate a term sheet, and I will just say this is the world according to Sean Churchill. I know Dave and Matt and Rob, they all negotiate differently. This is just kind of my style. It actually takes me about 6 weeks to negotiate a term sheet. This is not a quick deal for me. It takes about 6 weeks, and during that time I'm doing some intense diligence. I'm really getting to know the CEO who I'm dealing with on a one-on-one basis. We talk 3-4 times a week as we slowly go through this. And the questions that are going through my mind are, what do they actually need? They're asking for capital, but what do they really, really need? When you boil it down, what do they need, and can we provide that? So I want to find out what they actually need the most, and if we can even provide that. And then I want to think, what's our must-have? If I have to entrench, what's the thing I have to have? And so I want to get that set. And during this process, what I want is, I want that CEO to be thinking, I've gotten to know this team. This team can provide us with so much value. We have to have them, even if it hurts us a little bit. And this is why you talk about price last, is because you want to be able to present to them the value that you bring forth to the company, their company, from our team. And when I say our team, it's our family. Everyone in here is part of that team that helps me and helps our team move forward. So that's the process that I'm looking forward to. So that's how I negotiate a term sheet. I was asked last year to kind of give a real world example. So I'm going to give a real world example. I'm going to whitewash it a bit, but there's a real world example of a term sheet that I negotiated. Now, this situation is a little bit different, because what we found ourselves in was, this is a company that we love the space, we love the technology, we love the CEO. This is all looking really, really good, but they've already got a term sheet. So we're coming a little bit late to the game. So they're about halfway through their round. They already have a term sheet negotiated that's agreed upon, and other venture capital companies have already layered in on top of that and invested with that term sheet, reinforcing that this term sheet is correct. So the question I have to ask myself is, we like the technology, we like the space, love the CEO, they've got an active term sheet, other VCs have already layered on that term sheet, reinforcing it. I mean, are we done? Do we just transfer the money? Do we just sign? I mean, is that what we do? Well, that's when, as I go through this process, I start realizing that this CEO is exhausted from fundraising. This CEO was literally traveling coast to coast every weekend. And there was a 3-week period where the CEO went, and after 3 weeks of traveling coast to coast, came back and had raised $50,000. Well, they probably spent $15,000 in this travel. And they were exhausted. They want to get back to work. They want to run a company. So the CEO's really, the real need at this point was the CEO was exhausted from this, wanted to get back, wanted to run the company, and professed clearly, hey, I've not commercialized before. I know what I can do. I know my positives and my weaknesses. I've not commercialized before. So that's when I realized their real need. What their need was, hey, we need to get this fundraising over, and their real need is we might need some help with commercialization down the road. So with that, then you start talking to the CEO, and you present to the board, and in what's left to negotiate, well, let's talk about governance. So when we talk to the people, I say, look at your CEO. Your CEO is exhausted. Your CEO wants to get back to running the company. The company's been kind of just paused here to a certain extent because they're running around trying to raise capital. How much do you need to finish out your round? And they said, well, we need 1.5 million to finish out a round. Okay, how about if we take all of that right now? If we take all 1.5 million and this is over, and I mean, they love this idea because they want to get the CEO back to work. But here's what I'm going to need for our company to do that, for our group to do that. We're going to need a board seat. In addition to that board seat, we're going to need an observation seat. And the reason we're going to need an observation seat, I want one person to be on the board that's the steady person on the board that helps drive the company, knows the ins and outs of it, the nuts and bolts of it. But the way we work best is we have an observation seat, so we have one of our partners there, because the needs of the company change over time. So early on, if there's financing problem, one of the board seats is one of the partners, one of our experts who's in finance. A little bit later, when they're starting to gear up and they may have supply chain issues, we have our supply chain expert swap out on that observation seat and take that seat. Later on, when they're worried about commercialization, we have a commercialization expert coming on that observation seat. So they're getting 2 heads for the price of 1 here. So they're excited about this. So yeah, board seat, board observation seat. Yeah, good to go. It's okay. Let's talk about those protective provisions now. So when we go to those protective provisions and we talk about them, this is the same slide, same 10 protective provisions. And now we've got a seat on the board. That's awesome, but it's 1 of 5. So you could envision all these things could go 4-1 votes against us, and the board would still get it through. So you really don't have much power at that point. So what you do is you sit down and you hammer out and you ask yourself, what do we really need? What is it we really need? And these are the 6 that we really, really needed, and you get veto rights on those. So you determine, and there's kind of two reasons that we do this, and I'll go through that. But you determine what are the 6 things that we absolutely have to have. They can't liquidate the company without our approval. We have a veto on that. They can't create a new security or increase stock without our approval. They can't pay a dividend on any capital stock without our approval. How about make a loan to any person or reclassify shares of stock? I mean, these are some basics. And realistically, I'll tell you, it's done for 2 reasons. One is we want to make sure that we can protect our investment and our investors, that we have veto rights, even though we only have 1 seat on the board. We want to negotiate so we have veto rights on this. But the other reason is kind of check the temperature of the room and check the individual across the table from you. If they push back on this, these should never occur. These aspects should never occur in a company. And if you get pushback, you have to actually stop and take pause and say, why are they pushing back on this? This stuff should never happen, and that's a red flag. So it's almost done as a litmus test on the person across the table from you. Is this someone I want to go into business with if they cannot grant us this? And I've said we have veto rights in numerous companies. And I personally have never activated a veto, and I don't think I know one of my partners who has activated a veto. But you want to have that in case you need it. So you get that. So going back to the board, then we've got our governance. You got a board seat, a board observation sheet. We've got veto rights on these 6 critical protected provisions. And the next thing to discuss is warrants. And what warrants are you negotiate a certain percent of the company that then you would have right to. You would have right to buy that stock for 10 years in the future at today's price. And so what that's doing is saying, hey, we're working together, and when this is a success over the years, I want to be able to capitalize and get this stock, this X% of your company at today's value. And you want to be able to do it in what's called a cashless transaction. So in this situation, if today's stock is $1, and in 8 years, this is being picked up by a strategic, and it's $11 per share, you don't even have to come up with the $1. You can just take the $10 difference off the table. So warrants are an incredibly valuable thing for our investors because that money comes right back to our investors. So in almost every single deal that at least I personally negotiate, and I know a lot of our people negotiate, we always have warrants attached to it that says, we are going to work our hardest for you to get you across the line, and when we do, we want to be able to capitalize on this. And so they set aside options for our group at this time, and then in the future, those options are ours at today's price, though. So that's how even with a tied up term sheet that other people have layered on, that's how at least I approach the negotiation of the term sheet to still try and make it the best deal for our investors and the best deal for us and the best deal for the company moving forward. So that's how I've done it. This was a term sheet that was already set. It went through incredibly well, and everything's going great. So that's the term sheet and kind of negotiation of the term sheet in a nutshell. All right, folks.
Is Sean not amazing? Seriously?
Thank you.